Well, good evening, everyone, and welcome to the first episode of the DairyNZ Farmers Forum series, Navigating Economic Uncertainty. Will it be plain sailing or choppy waters for dairy? I'm Rowena Duncombe, and it is my pleasure to facilitate this series as we discuss the bigger picture issues impacting the business of dairy farming. Tonight, we have three speakers joining us. Our guest speaker is Cameron Bagrie. Now, Cameron will be well known to many of you as a leading economic commentator in New Zealand with over 20 years experience working in the sector. Plus, on our panel today, we've got DairyNZ Principal Economist, Dr. Graham Doull, and also Paul Bird, Lead Advisor for Solutions and Development at DairyNZ as well. So let me just explain the format of tonight's session. First up, we're going to have Cameron to provide insight into the likes of COVID-19 impacts, increasing interest rates, I know you're all interested in those, carbon pricing, the milk price, international trade, and also labour shortages, which I'm sure many of you are also familiar with. And that's going to be followed by question and answer time as well. We'll also put some questions to Graham and Paul around the implications for on-farm decision making. Plus, we'll get their views on how to ensure your farm business is positioned well to navigate the changing environment. Right throughout the evening, we encourage participation from you at home, and that you'll have the chance to pose questions to our experts. How you do that is super easy. A QR code is up on your screen at the moment. All you have to do is simply scan this with the camera application on your phone. That'll bring up the question portal. Then you just type your question in and you hit submit. Alternatively, you can go to menti.com and type in the code 76035073, which is also on your screen. That's menti.com and the code 76035073. When you do so, we just ask that you please indicate who your question is directed to. You've got Cameron, Graham, or Paul to choose from. Right, let's get on with it. Cameron Bagrie from Bagrie Economics, the floor is yours.
Oh, good evening. Look, and thanks for having me. Pleasure to be here, and obviously some pretty interesting times at the moment in regard to what's going on. What I'm going to do this evening is take you through, I guess, a little bit of a bigger picture view in regard to what we're seeing out there, largely focusing a little bit more on the bigger picture stuff as opposed to the here and now. So let's sort of kick things off if this automatic clicker will work, which it doesn't appear to be at the moment. So if someone's got control of this on the other end, could they please hit fast forward? Thank you. So if you had to look, theme one, let's celebrate a little bit of success in regard to what's going on across the dairy sector over the past 12 to 24 months. 5 to 6 years ago, it's fair to say there are an awful lot of economic challenges facing the dairy sector in regard to their resilience, and a lot of that sort of related to pretty high debt levels. Not an awful lot of lending was being made at what we call principal and interest. There was an awful lot of interest-only loans out there, and naturally the banking sector was sort of stepping back and saying, look, the sector needs to sort of sort itself out. And there were some pretty tough conversations that have gone on over the past sort of few years between the bankers and the dairy sector. But let's celebrate some success. If I look across New Zealand at the moment in the past 2 years, what I've seen is, by and large, a few warning bells are starting to ring in regard to a whole lot of other sectors. One of the sectors where I've seen the converse trade go in the other direction, where I think a sector has improved their resilience over the past sort of 2 to 3 years, and it's not acknowledged enough, has actually been the dairy sector. And then lo and behold, you build your resilience up, and banks now are saying they have a little bit more interest in agriculture. So if you look at your credit availability, going forward relative to what the dairy sector have experienced in the past 3 years, we're now sitting on the positive side of the ledger. To put that in perspective, the statistics are saying at the moment that the banking sector is going to shy away an awful lot from housing-related loans. Now, strategically, thinking about the bigger picture here in regard to where New Zealand needs to go, I think that's a great story, because for too long we've been donkey deep looking at the provision of housing loans, that sugar fix sort of stuff, and we haven't been channeling enough lending into what's called the real productive part of the economy, of which the agriculture sector is a pretty big sort of part. Now, I know within some of the surveys that the the primary sector is not seeing this on the ground. There might be a little bit of perception versus a reality issue in regard to banks are saying they're open, whereas their farmers are saying, well, it still seems pretty damn hard in regard to what's sort of going on. But what we are still seeing is a pretty tectonic shift in regard to where we sit at the moment. Can someone sort of move on to the next slide as well? Second theme that I've talked about quite a lot over the years is the whole idea of disruption. And obviously we've been disrupted in the past 18, 22 sort of months in regard to COVID, but pre-COVID there was a pretty big structural shifts that were going on. Obviously, climate change, natural disasters, big weather changes were major themes that your farmers and all parts of the economy just needed to manage. If staffing was an issue pre-COVID, well, what do we know now? Well, it's a bigger issue because with borders shut, all of a sudden we've suddenly found out we've underinvested in critical infrastructure, which reflects sort of people. So now we've got a massive issue across New Zealand in regard to whether we've got the skill sets for the jobs on the ground. We might have a low unemployment rate, but we've actually got rising benefit dependency, and I'll talk a little bit of that down the track. The government is becoming obviously a lot more interventionist. Technology is playing a huge role. Society's tastes are changing. There's more demands in regard to what we call ESG style reporting. And one of the ones that I'm watching at the moment is obviously what's going on in China in regard to Evergrande. To put Evergrande in perspective, Evergrande, which is teetering on default, is a company in New Zealand terms that is equivalent to 1.5 times the scale of Fletcher Building. Now, if a company of that scale in New Zealand was facing some economic challenges, you can bet your bottom dollar that will be having a pretty big impact across the broader economy. Now, I'll just put that out there because China's been a pretty big success story for New Zealand for a long time, and we've unlocked those opportunities. We've done really well. With opportunities comes risk, and what we've got across New Zealand at the moment is a pretty big reliance as well in regard to our connectivity or our reliance upon the whole China story. Can someone flip to the next slide, please, as well? While I try to get this thing up and running. Theme 3, there's a big theme out there at the moment which people are talking about. We're patting ourselves on the back in regard to how well the economy has done in regard to demand. The housing market's off to the races. You talk to pretty well all businesses out there at the moment. The biggest problem is not the lack of demand, it's actually meeting demand. Now that's a reflection of what we call sugar candy economics. It's a combination of record low interest rates, large-scale asset program, and a huge amount of government spending that's been poured into the economic system in combination with a little bit more fundamentals such as strength in commodity prices across the rural sector and redirected offshore tourism spend back into the local market. Now step away from demand. Demand is a little bit like running a 1,500 metre race and sprinting for the first 400 metres, and then all of a sudden you realise you're out of puff. The ultimate sort of story here is where are you going to finish that 1,500 metre race? So the line that I pay an awful lot of attention to is not demand, it's not that temporary sugar rush, it's how the economy is going to go consistently over time. And what we now know, and the penny is starting to drop, is that on a whole lot of levels, what's called the supply line for New Zealand, or more broadly potential output, how fast we can grow from year to year is starting to take a few hits. Now, some of this reflects COVID, but some of it reflects, adapting to the challenges of climate change. Some of it reflects the fact that we're seeing rising benefit dependency, a less efficient labour market. There are a lot more costs that are appearing in the system, so revenue might be up, but what we're also seeing is that the cost line is being seriously challenged, and of course, regular compliance burden, well, that shows no signs of letting up. So I think there's a great opportunity at the moment to really start to shift this debate, this narrative. Yes, demand, pat on the back, New Zealand, we've done incredibly well. But if you look at the ultimate building blocks of wealth creation, where New Zealand is going to be 4 to 5 years down the track, it's not about demand. It's the ability to meet the demand. And what we need to start to do at the moment is to start to shake the tree a little bit in regard to having those really tough decisions, because at the moment the Reserve Bank is dialing things back. And we can either hit demand, or else we can focus on the building blocks of a stronger economy, which is actually talking about supply. Next slide, please. And I'll just give you an example of this. The MPI came out, I think it was the middle of last year, second half of last year, and they had this export growth target, which they called ambitious and achievable. It was under the characterisation of fit for a better world. So the baseline, what's called compound annual growth rate for the primary sector, was 1.9% per year. That was reflecting a little bit of economic reality, where we don't think we're going to get as much volume-based growth out of lots of the dairy sector. But what they worked out was that with all these sort of things that we can potentially execute on, maybe do a little bit better in regard to free trade agreements, and hat tip to the government in regard to what's going on in the UK, that was a really good deal. And we need to acknowledge that. We're not going to see the real benefits for 10 years, but we are starting to see a little bit of movement. But if you step back and you think about the bigger picture, the baseline and the additional potential, that was going to give us potentially export growth of 3.4% per year. Now, stepping back, big picture, how have exports performed for the past 20 to 30 years? Exports have grown around 5% per year. So what the ambitious and achievable growth target that's on the ground at the moment is telling us is that exports are going to shrink as a share of GDP. Now I look at that, and I don't think that is an encouraging story in regard to where New Zealand is going to be 20 years down the track. Now, we need to once again wake up to the realities in regard to we are going to be constrained volume-wise. But I sit there and think about, are we selling ourselves a little bit short here in regard to what those aspirations actually need to be? And one of my hopes is that out of the sort of world we live in at the moment in regard to economic challenges, rising interest rates, inflation, maybe we're going to be a little bit more prepared to have those hard discussions in regard to some of those real big levers that we need to pull going forward to sort of lift our aspiration and get that supply side capacity of New Zealand going down the track. And of course, the primary sector is a very big part of that economic base. Next slide, please. Our theme 4, as you're building on what I talked about earlier in regard to the supply line, New Zealand at the moment has really been caught up in what I call sugar candy economics. Awful lot of back slapping. How good is that house price movement? Low interest rates, low unemployment. We've done incredibly well. It's a little bit like if anybody was at that test match in Twickenham in 1999, All Blacks versus French. How New Zealand has gone in the past sort of 18 months has been a little bit like the first half. Well, you've got to think about the full match in regard to what's going on. And this is really shifting attention at the moment away from demand and thinking about what are the real building blocks of where the economy, living standards are going to be. It's all about supply. Demand management is easy. And shifting, creating growth is not. And this is where you need to have those hard conversations. And I think it's some time for some pretty serious conversations on unlocking a lot of those opportunities in regard to water, natural resources. Benefit dependency. We've got record low unemployment rate, 3.4%, or almost a record low. 1 in 9 people in New Zealand, that's 355,000 people, are still on a benefit. There's more people on a benefit today than what there was pre-COVID, yet we've got the unemployment rate down to the same sort of pre-COVID levels. So that sort of tells us something's going wrong here. We need to have those conversations with regard to compliance costs. And of course, a big one out there as well is also infrastructure. Some of the stuff's beyond our control in regard to reconnecting to global supply chains. It's going to take a little bit of time for that sort of stuff to come back online, but that should not stop us from having an awful lot of those hard conversations and really morphing to a different stage. And once again, what's happened in New Zealand is that we've got a situation, we've got excess demand. What happens when you've got excess demand? Inflation pops. We can either fix that by curbing demand or getting supply up. Next slide, please. So if you look at what's turned up of late, it's what we call the inflationary thief. And inflation is not just turned up at New Zealand's doorstep. If you look at the headline inflation rate in the United States, it's up around 6%. We're also seeing broad-based inflationary pressure in an awful lot of countries around the globe. The Reserve Bank just released their own projections yesterday, and they've got headline inflation moving from 4.9% at present up to 5.7% in the December quarter, and taking a little bit of time to move back down towards that magic 2% number over 2022, 2023, 2024. Now, normally when we see an inflation spike, it's driven by oil, petrol, or another one-off such as GST. And we can sort of get on control of these things pretty quickly. Yeah, what we're seeing at the moment is a little bit more broad-based inflationary pressure, which makes it a little bit more difficult and awkward for the Reserve Bank. Their assessment at the moment is that inflationary pressure is going to be, could we call it somewhat transitory? And we're going to come back down on the other side. Next slide, please. The good news story out of inflation is that it tends to be good for some sectors, and it's one of the reasons we're seeing dairy prices that have spiked up. So if you look at the FAO Food Price Index, and these are the numbers up to October, and I know the numbers have spiked again in November, look, they're trading well above the average rates, whether you look at a nominal or in real price terms over the last sort of 10 years. Now some of that I think is core underlying demand. The world is so short of food. We saw a directive coming out of China 2 to 3 weeks ago, basically telling people to stock up on food, which I'm not quite sure whether I want to express that as glass half full or glass half empty, but it was a directive as well. But the bottom line is that the world still needs to eat. New Zealand produces food. We've got our supply chain open, and we're pretty damn efficient in regard to what we do. So the story looks really good. The glass half empty story, and if you move to the next slide, is that while dairy prices are up, what we're seeing on the ground is that very strong increases in costs. So if I have a look at dairy costs on the last 3 years, and these are costs excluding labour and interest in livestock, so the more of the core cost variety, your core costs in the last 3 years are up about 15%. Now, if I have a look at what we're seeing in the past 12 months, we're seeing a lot more rapid rises than that. So you sort of wonder in regard to, where is this appropriate balance we're going to see this? The income line looks really good. Some would say somewhat remarkable. A mixture of structural fundamentals, permanent shifts, but also probably a little bit more temporary. But the key thing for the dairy sector to keep an eye on in regard to where we're going to be in the next 12 to 24 months is obviously whether we can arrest that ballooning cost line. And this is where the dairy sector is like an awful lot of other sectors across New Zealand. There's no differences. The critical question here is inflationary pressure going to be transitory, or is inflationary pressure going to be a little bit more sticky? And of course, what we're seeing out there at the moment is that the market's pretty balanced in regard to, you can place a bob each way in regard to what your view is likely to be. Next slide, please. Theme 6 is the whole theme of rising interest rates. And I want to look at rising interest rates through two lenses. Look, lens 1 is just the impact of what we call a rising risk-free rate. So the risk-free rate sort of defines on a whole lot of levels your expected return. So bond yields fall and you're expecting what's called constant compensation for risk, then constant compensation for risk, or the spread above bond yields, in combination with falling bond yields, means a lower expected return, means asset prices go up. What have we seen over the past sort of few years? Yes, falling interest rates have driven up asset prices a long way. It's a different story when you get into a rising bond yield environment where risk rates start to move up. And you start to ask, well, what's going to drive asset valuations going forward? And what's going to drive asset valuations going forward has got to be about asset quality. It's about the ability to add value. It's about the ability to extract extra rent or income. So I'll give you an example. The Reserve Bank did some work about 18 months ago, looked about the property market. What had driven house prices between 2009 2019 was a combination of rents, positive, interest rates, positive, and inflation were negative. Now, if I have a look at where we're going to see for the next sort of 10 years, because interest rates have turned around, well, interest rates are going to be a constraining factor on asset price growth. Now, inflation is probably going to give us a bit of a nudge in the other way. But when you get into a rising interest rate environment, if you want to maintain your asset valuations or add to asset valuations, You've got to get back to those economic fundamentals in regard to cash flow and just making more money, extracting more of a premium out of that asset. Now, we've talked about this sort of stuff for a lot of years. I'm still not sure that the penny has actually sort of dropped in regard to what a rising risk-free rate actually means. Yeah, but we've been seeing the risk-free rate, interest rates, if I look at a 10-year bond yield, is trading 200 basis points higher than what it was 12 months ago. Yeah, that is a really big shift. We've yet to see asset values start to reflect that structural shift. Next slide, please. We're also seeing, when you get into a rising interest rate environment, the question becomes, well, how far are they going to move up? The bad news story is that interest rates are going to move up. The good news story is that interest rates are still going to remain pretty low. So what we're looking at the moment, the Reserve Bank came out with their assessment yesterday, and key word there was considered in regard to how fast they thought interest rates were going to be moving up. Considered is just a fancy name for saying interest rates are probably going to move up by 25 basis points per meeting over the next 18 months. What does that mean? The official cash rate probably gets to 2.5%. Now, historically, 2.5% is still incredibly low. Yeah, but if you've jumped in late to the property borrowing cycle in the past sort of 12 to 24 months, the 2.5% official cash rate is going to mean a pretty big hit to your borrowing costs. So glass half full of that is that I think it's going to accentuate the desire for New Zealanders to start looking at real productive assets to investing in, such as the agriculture sector, and lessening our reliance upon the housing market, which is really about playing the long game as opposed to the short game. But we just need to accept, look, it's a different environment going forward. Do I expect interest rates to move up to anywhere near like we've seen 10 to 20 years ago? The answer is no. But people have got more debt. People are a lot more vulnerable, so smaller rises in interest rates are going to hurt going forward. So watch this space. Final slide, please, and I'll just sort of wrap it up very quickly. Some things to think about. Look, congratulations to the dairy sector. You've done incredibly well in the past sort of 2 to 3 years in regard to cleaning up your act. That is a story that I don't think is appreciated sufficiently, and it needs openly acknowledged. And the great thing we're seeing at the moment is the banking sector is looking a lot more receptive in regard to writing agriculture-based loans or real productive stuff. And I think that's an encouraging sign. Disruption is the new normal, or what I say, and I've been talking about this for a while, 1 + 1 now equals 11. How do you handle disruption? You need to learn to take risk. Not taking risk is no longer the risk-free strategy. We might be able to get the private sector going down that route, but I'll tell you what, it's a big challenge to teach the public sector, local and central government, to learn to take risk. And a classic example at the moment is, their model for the tourism sector. The tourism sector is going to bleed for a very long time because we're just not prepared to take an awful lot of risk. Inflation's a big wake-up call. Watch the space. Demand's the easy side of the equation. Where we need to be shifting the debate is about supply. Where do we find those workers? How do we reconnect with the global economy? We cannot remain the hermit economy indefinitely. What are New Zealand's unique comparative advantage we can extract a little bit more growth from? What's that firm growth agenda in regard to extractive maximum opportunities out of the likes of water? We need to shift the narrative from temporary COVID-related reaction function to thinking a lot more about the bigger picture. That is the bigger game where we're not seeing an awful lot of action on. The interest rate tailwind's now a headwind. I think that's a major change for wealth creation. Now it's about fundamentals, cash flow, yield, just making a buck, adding value and being a lot more smarter. It's a big reality check. I used this term before. Now the real mahi starts for the economy. Personally, I'm going to enjoy the next sort of 2 to 3 years because things are going to tighten up. And I think that's a good economic story, because when things tighten up a little bit, you need to have a lot more of those hard debates, hard discussions. You can actually see a little bit of movement. When things are easy and going well, you don't see an awful lot of appetite for change. I think we're moving into an environment there's going to have to be a lot more big, bold decisions made, and I'm looking forward to it. Thank you. Back to you, Rowena.
Thanks, Cameron. I like what you had to say about exciting times ahead. Look, let's get into some of the questions. Remember, if you've got a question you'd like to ask Cameron or even Graham and Paul later in the session, there's a QR code on your screen now, or you can head to menti.com and enter the code 76035073. Now, Cameron, one of the first questions for you is a really interesting one, and I mean this quite literally as well. Why are New Zealand interest rates headed up and most other countries are not?
Short answer is success. Yeah, we've done a lot better than most other countries around the globe. Yeah, we've managed to get our unemployment rate down to 3.4%. Now, to be fair, I think that reflects the short game as opposed to the long game. Yeah, but the Reserve Bank has turned the dial to try to tame the inflationary pressure. And if I was a farmer out there at the moment, I'd be quite supportive of the Reserve Bank. Why? Because where's the bigger threat? Is it coming from big increases in inflation, or is it coming from bigger increases in interest rates? And I think it's probably the threat to your bottom line is coming more through bigger increases in inflation. Now, the hope is that the Reserve Bank, by going a little bit earlier, is not going to have to go as aggressively late in the cycle. I think some other central banks around the globe are going to find themselves in a pot of bother in about 6 to 12 months if they don't start to lift interest rates pretty soon and start to address what I think is a big fundamental issue. Inflationary pressures are percolating.
Is stagflation, Cameron, and the 1970s around the corner?
You wouldn't rule anything out at this juncture. If you go back and think about, well, what's stagflation? Stagflation is a combination of, the economy is stagnant, unemployment is moving up, and inflation is rampant. Now, to be fair, the economy at the moment has got a couple of those characteristics. So inflation is moving up, and the economy is feeling a little bit stagnant as we start to deal with COVID. What do we do not have? We do not have rising unemployment. In fact, we've got full employment. The biggest problem for firms out there at the moment is actually finding skilled staff. My characterization is not what's called stagflation. I call it slugflation. There's slugflation as firms, including farmers, getting slugged with higher costs and inflation moving up. And it's going to morph into what we call grumpflation, which is society starting to get pretty angry about things because, headline inflation rate 4.9%. If you're not seeing your wages move up by 4.9%, you're moving backwards.
Brilliant. I love that. I've learnt 2 new words tonight, slugflation and grumpflation. Cameron, final question for you. Is inflation pressure transitory or persistent?
Well, some of the inflationary pressure we're seeing at the moment is transitory. It's due to supply side distortions due to COVID. As we reconnect with the global world and we get shipping chains back online and oil prices start to subside eventually, we're going to see some of that inflation pressure dissipate. But there's also, I think, an element of stickiness to this inflation dynamic. And we're starting to see structural shortages within the labour market, which means what? If pay increases are going to be a permanent feature, I think, for a long time to come. The Reserve Bank had within their latest monetary policy statement some interesting analysis on the inflationary consequences of climate change. And hey, presto, dealing with climate change costs. And I'm not sure the average consumer realises out there that addressing climate change is going to hit you in the wallet. Government policy, structural shifts, it's more inflationary. The more we shift back from a globalised model, the more we're going to add a little bit more to that local inflation impulse. So I don't think the inflation genie is going to get let out of the bottle, but I think we are moving to an environment where the average rates of inflation for the next 10 years is going to be closer to 3% as opposed to 2%, which is what we've experienced for the past 20 to 30.
Cameron Bagrie from Bagrie Economics. We've run out of time to ask you what you made of the National Party debacle today. I know not only are you a very keen economics contributor, you're also quite a keen commentator on politics as well. But look, we really appreciate your insights and your views tonight. Certainly food for thought. Thank you so much for your time.
Thank you.
Now, look, remember, you can submit questions at any time. Either scan the QR code that is on your screen now, or you can head to menti.com and put in the code 7603 5073. It is now my pleasure to welcome Dr. Graham Dool and Paul Bird into our conversation this evening. Now, Graham is DairyNZ's principal economist, specialising in the economic assessment of farming system, and leads the DairyNZ economics team. Paul is a lead advisor in DairyNZ's solutions and development team with a particular focus on farm business. So welcome in, gentlemen. Thank you so much for joining us this evening.
Thanks, Rowena.
Now, Graham, we are going to start with you. First question. Farmers are seeing input costs are going up right now. We're hearing so much about this. What is causing it, and what can farmers do about it?
Yes, when we look at the underlying dynamic, as Cameron spoke about earlier, it's a really interesting dynamic and one that I haven't seen in 20 years of working in the economics field. We've got COVID-19 is really affecting the world trade situation. Like on the shipping side, for example, we're having increases in shipping times of 75%. We've seen in the last 6 months alone, we've seen the cost of shipping goods from Asia to the US go up by 15 times. And so this is just due to port delays and closures. And so that's what we're really seeing, this underlying dynamic of very high input costs. It's quite expensive. We're seeing superphosphate's gone up by 15% in the last year. Urea's gone up by 67% in the last year. And some things that we're seeing as well is that internationally, the demand for food is still very high, though. You know, I've been through a few lockdowns now, and my clothes are getting smaller each lockdown. You know, we're not seeing this dynamic where demand is decreasing. But worldwide, our food prices on average are up by a third in the last year because of these higher input costs. When we bring it back home to dairy farm production in New Zealand, the big thing really is planning. We often hear people talk about the pandemic when it comes to people wearing a tin hat and talking about that this is a big conspiracy theory. But really what we need to focus on is just, even though we have a high milk price, what we're going to have for the next year or two is that high cost inflation, so that cost pressure. So really it's just planning, how can we reduce our costs, be efficient in our production? That's the big low-hanging fruit for our industry, I think.
Graham, look, I just want to reassure you, first of all, you're not the only one whose clothes have been getting smaller and smaller with each lockdown. So I'm sure a lot of us can relate to that one. Look, Paul, over to you. Any thoughts on how farmers can mitigate the impacts of labour shortages? This is something that is not going away.
No, it's not going away, and I think the first thing to acknowledge is that there's real, pressure out there at the moment. There's a lot of farms, with staff shortages. Over half of farmers are saying that they're missing people, and a lot of people haven't had a break since calving, and so definitely a lot of pressure out there. DairyNZ, Federated Farmers, Dairy Women's Network, they have been doing a lot of work advocating for farmers with government, and that has had an impact. But if you're watching this now and you're right at the moment, you're missing staff members, you might say, well, it hasn't had an impact on me today. So I completely understand that. But in a way, if that's your situation, you sort of need to put that aside and say, well, what's actually in your control? And the reality is that to attract and retain people, it's a really competitive sort of labour market out there at the moment. So you actually just have to be competitive. And we know that there's three main things. To be competitive, you've got to focus on three main things. Your remuneration, you've got to be competitive in that area. And for most people on farms, the house is part of that sort of package. So quality housing, competitive wages. Second one is hours worked and rosters. Again, that's sort of changing over time. So you've really got to be aware of where that's sitting in your region. And again, you have to be able to compete in that area. And I think the third one, really important one, is having a real genuine interest in the people that you're recruiting or are working on your farm. And, we all know, don't we? If we're working for people, we know if they're interested in our success, and I think that's a really key thing, is to show genuine interest. Those people who want to progress through the industry, how can you help them? How can you sort of mentor and provide training for those people? So just listening, finding out what's of value to them. So really, those three things, focusing on them makes a difference and just enables you to compete better in a very tight market.
Yeah, brilliant advice there, Paul. Thanks so much for that. Graham, heading back to you, we're seeing high forecasts for the milk price. What is predicted to happen to these in the near term?
It's a great question. Thank you, Rowena. When we look at the dynamic right now, there are four things which are really driving it. One is that New Zealand has managed to secure throughout the pandemic very good access to affordable ocean freight. And so that's been one thing which has helped us maintain access to our international demand. However, what has also driven up milk price worldwide is we've still got that strong demand that I spoke about earlier and that Cameron alluded to, but also the fact that it's costing us more to produce this milk is putting pressure on the price worldwide. And what we're seeing as well is that we've had a poor production season across Europe and the US, and so it's down by about 1 to 1.5% across both Europe and the US, which means that there's less supply, which is pushing up the price as well. And so, like all Kiwis at the moment, I'm a bit of an epidemiologist, and one thing that I'm looking at, especially what we're seeing in Europe, is that this pandemic's not going away anytime soon. What we do when we look at the production seasons overseas, we do see that Europe and US, they'll probably produce more next season. They'll probably be around 1% up rather than 1% down, which they are at the moment. So that's going to put more milk into the global market, more dairy products into the global market. However, the access to ocean freight is still going to be a competitive advantage for us. And also the fact that our cost-effective systems based on pasture grazing and that strong demand will persist as well. And so really what we see is that with the increase in global supply, what we'd expect is the price to come down. But given that we're still going to have cost inflation related to the pandemic, what we'll see is probably a fall in the milk price, but still around our average that we've seen in the last 20, 30 years. So I'd still expect into the next season a milk price above $6.50, given that the world's not going to correct itself anytime soon.
Yeah, fantastic. I think we'll all take that. Thanks so much, Graham. Paul, there's always a lot of uncertainty facing dairy farms, for example, around milk prices, we've just heard, fertiliser costs, interest rates as well. How can a dairy business prepare for this?
Yeah, it'd be great, wouldn't it? Just to be able to not have any uncertainty and just be able to predict everything. But, it's just an impossibility. And so, if you look back over time and you think of these big events as well, not just even small events, COVID-19, back to 2015, we had $3.90. So really the only way to, sort of withstand this unpredictability and these shocks that come through is to actually have a really solid, profitable business. And, I think it's a bit like walking across a bridge, isn't it? That's got big crosswinds coming at you. You've got to have both feet on the ground and you've got to hold on to the rail. And from a financial perspective, the way to stay on that bridge and not get blown off for a swim is to have a really high operating profit margin and a really high operating profit. And that gives you that buffer in those margins. And so operating profit margin, that's really about the proportion of the revenue that's coming in from, milk and stock. What proportion of that revenue can you sort of retain and then you have available for investing, paying debt off, and tax and drawings. And really, 35 to 40% is really the target, and probably this season could be even higher. Return on assets at the moment, the average is about 5%. And even though interest rates might not skyrocket up, if they start creeping up to 4, if they come above 4 and start getting 5, 6%, that's going to put the business under more pressure. So trying to get interest rates up to 6, 7, 8%, which is what some people are doing, gives you that buffer, margin of safety. You know, engineers have the same term. How strong does the bridge have to be? And so how do you lift profit margin and return on assets? It's really three skill. People I see that do this very well have three skill sets that they're excellent at. Financial management skills. They have very good grazing management skills. You know, that's the sort of competitive edge that we've got in New Zealand dairying. And they've got good people management skills if they require people. So even though there's a lot of uncertainty, I would say there's also a lot of opportunities for people who are good at those three things. And just my sort of final comment on this is that I think there's some very, you know, there's managers, contract milkers, she milkers out there who are, you know, the advice I'd give them is that if you can become very, very good at those three things, you'll get a very good reputation in the industry, and opportunities will open up for you. And I think it's actually a really exciting time for the industry and for people coming through if they're good at those three things.
Brilliant. So those three things again: financial management, grazing management, and people management. Thanks, Paul. Graham, how competitive is the New Zealand dairy sector on a global stage, given what is happening to costs and prices at the moment?
Yes, well, one thing that I'm seeing is that all agricultural sectors, the main ones that I've seen across the globe at the moment, are affected by that dynamic. You know, this is not unique to New Zealand dairy. We're seeing this dynamic across most sectors, and in fact, there are some that are more profoundly impacted than we are currently. The thing that's really helping us through this time, and it's really shown in our strong milk price and our strong economic contribution to the economy, is that we've always done the fundamentals well. Like, with most competitive dairy country in the world, the most competitive dairy producer in the world, we have a cheap source of feed and pasture. We have well-established ways of farming and those grazing management and financial management principles that Paul mentioned. And the other thing is that we have a really strong history in the way that in that we support our dairy system through research and development. And I think moving forward, they're really going to be the things that we leverage off. Like we're seeing overseas, the countries with much less well-developed export functions aren't doing so well. For example, in the US, they're producing more milk than they can sell domestically right now, but they can't get it on a ship because the ships are getting paid 15 times more, or about 15 times more to carry products one way than the other. And so what we're seeing is unloading goods in the US and then going straight back to Asia without filling up with US product. And so we're not having those issues. And so I think moving forward, we're going to remain the chief competitor, the most competitive system and most competitive supply. But the thing we've got to watch is that cost inflation. And so it's building on those fundamental skills that Paul has mentioned.
Yeah, it really comes back to that importance of access to the overseas markets and also those strong trade relations as well. Paul, a couple for you. Industry debt has gone down by 10% in the last few years. Should farmers be worried about interest rates going up, as we've heard from Cameron, that there's only kind of one way for them, but also still reducing their debt?
Yeah, well, it's not ideal, but I'm afraid I can't control those interest rates. But I think in general, you know, trying to reduce debt is a good thing, even though the industry debt has dropped down to that 38 billion mark. You know, the average dairy farm still, if you look at the asset base, it's still made up of half debt and half equity. So it's still quite a big chunk of debt. And if the returns they're making from farms is 5% and the interest rates start to get close to that, you know, that does put things under a bit of pressure. But, you know, like paying off debt, it puts you in a good, secure position to withstand any of these shocks that we're talking about. Or, you know, it puts you in a solid place to invest if you might be looking for the next opportunity to grow in dairying. And so just paying off debt, just, you know, you might not find something in a particular year, but it puts you in a good, solid position to for you to take up the next opportunity. What your debt level should be, I don't think there's a particular figure. It relates to well, it relates to what your goals are and what you're comfortable with, but also how profitable your business is. If you can operate at a return of 7 or 8%, your business is in actually a much stronger position to carry more debt. You've got a bigger gap between the returns that your business is making and what you have to pay the bank in interest. If you're down around the 4 or 5%, then really focusing on getting that debt down is a sound, I would say, a very sound investment decision.
Paul, what milk price should farmers budget on, given we know it can change so much, as we saw back in 2014 into 2015? How conservative or optimistic should you be?
Yeah, well, look, that's a good question. If we look back over the last 10 years, we've had 3 seasons above $7, we've had 3 seasons below $6, and we've had 4 in between $6 and $7. And so if you pick the midpoint, that's about $6.50. Fonterra in their new strategy, they're talking about trying to aim for a range between $6.50 and $7.50. So I think for most people, being reasonably conservative and having that $6.50 milk price is a reasonable starting point. Some people might say that's a bit conservative, but I think it's a reasonable price with some dividends on top of that. I think the key thing is to think about what can happen on the downside and the upside of that. So you might set your 22-23 budget. This season's looking much better than that, but 22-23 season. What happens when the milk price is significantly higher than the $6.50, which it does look like this season we're going to get? And if you've got a plan in place to actually utilise that extra money, it's very important. And another couple of dollars on top of the $6.50, it's a lot of cash coming in, and you can spend that or invest that unwisely. So I really suggest people sit down and think about how they're going to invest that money. Is it debt reduction? Is it reinvesting in some housing or setting up a farm, or off-farm investment, whatever it is that you think is the right thing to do. I think on the downside, I think it's also, a very good Taranaki farmer said to me they always have the war budget in the drawer. And, we hope this doesn't happen, but we know that it has in the past. And so have a budget in the drawer where you put on a really low milk price, and, let's just pick $5. I don't know what the right number is. Put that in there and develop a plan so you know how you're going to navigate if things turn to custard and we get a really low one. How will you sort of hunker down on that bridge and not get blown off by a gust of wind? You're still there, and then you can sort of start moving forward again when the wind dissipates. So I think $6.50 is a good price, but have really good plans in place on the upside and the downside.
Yeah, good stuff. You can always trust Taranaki dairy farmers. It's where I did all my dairy farming too. Hey, final one for you, Graham. Do you think the average farmer will have to reduce their milk production per hectare in a few years' time due to greenhouse gas and water quality limits? Controversial one, this.
Yes, and it's a very good question. I've spent a decade working in this area. I was an economic advisor to the New Zealand government in this area of, trying to assess the impacts of policy on pastoral farming. And one thing that I always noticed was that the most significant costs that a farmer will bear because of policy are those associated with large drops in production or significant drops in production. So the key is, I think, in the next 10 years, I don't think in the next 10 years an average producer will have to drop their production significantly because of water quality or greenhouse gas policy. And that's for really 2 reasons. The first reason is that I feel that regional governments and national government are actually being quite fair about a transition, they're not talking about quite stringent changes right away. We're talking about staging, and I think that's really important, and we have to give policymakers credit for that as we see that develop. But that's the dynamic I'm seeing at the moment. The second one is that there are some really exciting technological innovations that are starting to come through. DairyNZ is leading some of these. Others are being done within the science sector outside of DairyNZ or in collaboration with DairyNZ. The big one that I see that I work a lot in is efficiency. I think that low-hanging fruit is that we know that 50% of farmers at least can produce the same amount of milk, but with less inputs, so with less feed and less nitrogen fertilizer, for example. So I think that's what excites me. When Cameron spoke about hard times really making the man, or hard times making the sector, I think this is actually a really exciting time. Our efficiency has been stagnant for 30 years, so I think this is the time that we can really build on that. And other technological developments or developments that I see coming, we have got three NOP, which will help to reduce the methane output or methane emissions from our grazing systems. Plus, we've got diverse pasture species which are coming through. We've got a large plantain project that we're working on at DairyNZ in collaboration with others, which is showing a lot of promise as a plant to reduce nitrogen loss from dairy farms. Another one is high condensed tannin feeds such as Lotus corniculatus, which we've seen also has substantial promise for reducing methane and nitrogen loss. So I think, really in the next 10 years, I wouldn't expect our production to drop. And I hope that's when it gets exciting for me.
Yeah, I love that. I say so often on the country, our radio show here, that New Zealand farmers are so renowned for their ingenuity, their number 8 why, their Kiwi way of thinking. We didn't get to where we are as leaders in the world by just doing the same old, same old. So I agree with your sentiments. It is a very, very exciting time. Look, some of the key take-homes from listening to you two, from me in particular, are the need for planning, the plandemic, as you put it. This is going to be key moving forward. The labour shortage, this isn't going away. Controlling the controllables there, giving yourself that competitive edge around remuneration packages. It's always a tricky one to say. The hours worked as well, rosters, and taking a genuine interest in your staff. They are going to pick up on it, and they really will thrive. Also, just that importance of access to overseas markets. We came back to that several times. The importance of your operating profit margins, the return on asset, that financial management, grazing management, people management, that trifecta is just so, so important. So thank you so much, Graham and Paul, for your time this evening, and also to Cameron earlier. Really, really appreciate it. Thank you.
Thank you, Kia ora.
Thank you.
Right, well, that is a wrap on this first episode, Navigating Economic Uncertainty. Look, we really hope you enjoyed it, and that you also gained some useful information and insights that are going to help you and your farming business. Our next episode is on Wednesday, January 26, where we're going to dive into the sector's commitments to reducing agricultural emissions. So during that session, we'll discuss the science behind the targets and the proposed pricing frameworks in He Waka Eke Noa. So that's our climate action partnership. You can find out where this is up to and also what it will mean on farm as well. In the next day or two, you're going to receive some communication with a link to tonight's recorded session, which will also include links to related information, answers to some of the questions we didn't quite get to tonight, and also the opportunity to provide your input into future episodes. What's important to you and what you want to hear about. Until then, enjoy the rest of your night. We look forward to catching up with you again next year. Take care. Ka kite anō.